Today, we're diving into how geopolitical events like conflicts around the world have historically shaken up the financial markets and the global economy. Now, this topic is super relevant given the recent escalation between Israel and Hezbollah and Lebanon, which has many people concerned about a larger conflict. And this comes almost a year after Hamas attacked Israel, all while other tensions like the ongoing war in Ukraine and rising concerns around China and Taiwan are still simmering. Now, don't worry, this isn't a predicting doomsday or diving into the headlines to make snap decisions. Instead, we're going to look at how these types of events have impacted the markets over the years, and more importantly, why it's crucial to keep a long-term view as an investor. So sit tight, because at the end of this, you'll feel more confident about riding out the storm without getting caught up on all the noise. For long-term investors, geopolitical events and regional conflicts are a constant part of the global landscape. While these headlines can be alarming, especially when they break away from typical market or business news, it's important to stay focused on long-term goals. As this chart illustrates, geopolitical events often lead to short-term volatility in the markets. For example, the Iraq invasion in 1990 saw the S&P 500 drop over 8% in 1 month. However, these short-term reactions do not necessarily indicate long-term negative trends. When the markets experience prolonged struggles following a geopolitical event such as 9/11, this is often due to other contributing market factors. For example, the dot-com bubble was already bursting during 9/11, and more recently, the Russia-Ukraine conflict coincided with rapid Fed rate hikes. Despite the initial shocks, markets have shown resilience. The chart shows that 1 year after many of these geopolitical events, the S&P 500 has posted positive returns. For instance, after the Iraq War began in 2003, the market was up nearly 27% a year later. Even in the face of significant global conflicts such as World War II and the Cold War, the 20th century saw numerous strong bull markets. The lesson? Markets tend to adapt and recover even amid global turmoil. So the key takeaway is, while it's natural to feel anxious during times of geopolitical uncertainty, overreacting to headlines can hurt your long-term portfolio performance. When it comes to global markets, oil prices play a starring role. Why? Because oil affects everything from how goods move around the world to how much we pay at the pump. So when oil prices go up, it can push inflation higher and slow down economic growth. With recent global tensions, we've seen some movement in oil prices. Brent crude, for example, has climbed from 69 to 75 per barrel. But before you worry about runaway prices, let's remember that is a relatively small jump compared to the past spikes, like the massive leap to $128 per barrel in 2022. The good news? The U.S. is now the world's largest oil and gas producer. This means we're not as dependent on foreign oil as we used to be. The increased energy independence helps cushion the blow of global oil price swings. So while the world may feel the heat from higher prices, the U.S. may be a little bit more insulated. Another reason why the markets may not be so jittery about the oil prices, the Fed has started cutting rates, which has helped keep borrowing costs down and the economy humming along. This could make markets a little less sensitive to oil price changes, well, at least in the short term. Did you know the stock market experiences about 5 pullbacks of 5% or more every year? It's a normal part of markets' ups and downs, but it can feel like a roller coaster if you're checking your portfolio too often. The key is not to panic during those dips, because history shows markets have a way of bouncing back. Now, despite all the geopolitical tensions this year, the stock market has proven resilience. The S&P 500 has just seen 2 pullbacks of 5% or more, while still delivering an impressive over 20% return year to date. That's pretty incredible when you think about all the worries investors have faced this year. This kind of performance is a great reminder to keep a cool head and think long term. Headlines might cause some short-term market noise, but those broader economic trends that really steer the ship. Staying focused on your long-term goals and not getting swayed by every headline gives you a better chance to win in the long run. Thanks for listening. Shoot me a message if you've got any questions. Look forward to connecting with you guys soon. Have a great day.